All right, everybody. So I've got a presentation about, it's a behind the scenes look at how I create seven-figure income every year selling options. And I'm going to show you just a little bit. I've got 56 minutes, 55 minutes to run through this. And my presentation is not only PowerPoint. I've got a mix of PowerPoint and actual trade slides. So we're going to go back and forth here. But just follow along. And I ask that you have a couple of sheets of paper and a pencil to take notes. If you're feeling confident, go for the pen. But let's take some notes because I've got less of a offer. I'll have an offer, of course, at the end, a small one, but more of learning. And I want to impart as much as I can in the amount of time I've got about selling options, because I've been doing this for almost 25 years now. And it's quite nice. Let's hit it here. All right. I like to start with this because this was posted on Facebook on April 16th of this year. This is from one of my mentors. Yes, I've got mentors too. I wasn't born this way. And this is what he posted. He said, "I just hate to be the guy to break this to you, but most of the self-described experts out there have their heads firmly up their butts. There are shortcuts to success, but none involve magic. So shame on you if you get involved in some scheme that you know sounds too good to be true." And a lot of people have been getting filtered out of the market. People who've been promised stuff like with crypto and stuff with, you know, all these things that come and go. Back at about 10 years ago, the hot thing was like binary options, and like a couple of years before that or after that was Forex. Everybody's always got something that's a shiny object that'll try to distract you, but you find what fits into your personal style of time. Like, how much time can you actually give to being an active investor? Do you have all day? Do you only have a couple days a week? Do you only have end of day? Do you have stuff that you have to do during the day? Make sure that whatever you pick up, your time can match it, because otherwise you're going to spend all this time learning how to do something or getting, picks, getting an alert service, and you won't be able to act on it. It'll be wasted money. Another thought that you might want to think about is make sure the risk appetite you're opening yourself up to, you fully understand your risk projection, because otherwise you might get into some strategies that if you lose, you'll lose half your portfolio, you'll wind up getting divorced, and you'll wind up being homeless. So, things like that. These are stories. These are real stories that have been told to me over the years from folks coming to me. So, and just make sure that you don't fall for some of this really amazing marketing out there, because I've seen companies, Trading Trainer's been around since 2003. I've seen companies come and go, and they make a crap ton of money off of people, and then they just disappear overnight. So maybe some of you have been involved with those companies, and I'm sorry if you have, but let's get onto it a little bit more. Hey, I want you to take a look at this sideways chart. This is something that we're going to come back to, but these are the type of charts of symbols that I'm looking for. So I like stocks, ETFs, indexes that go sideways. Now, most people would be like, I can't trade that, but we can turn this into an income trade very nicely with different option strategies. So here are the facts. First of all, what's happening right now, especially with the Fed, are they tightening? Are they loosening? Are they buying bonds? Are they selling bonds? There's a lot of uncertainty, but if you know how to play what's happening in the markets right now, you will be set up for months, if not years. See, the key is understanding that even though mainstream media tells you that, this many $1 trillion was destroyed in the markets, that's not actually what happens in the markets, and you should understand that. What happens in the markets is money moves from one hand to another person's hand. And the key is knowing what side of the equation you're on, right? Are you on the correct side of that transaction? So my first question for you, and if you don't mind just chatting something into the chat box, what would be ideal for you? Because I can kind of tailor today's presentations a couple of different ways. Are you one of those investors who likes to learn how to invest for low risk and high return? In other words, you're a learner. You want to learn how to fish and then go off and do this yourself. Or are you somebody who wants to have seasoned investors look over your shoulder and look at the investments you do before you make them? So in other words, you learn how to fish, but you also have expert fishermen there to help you if you need it. Or maybe you're just a follower. You like to follow what seasoned investors do in their portfolio. In other words, you like to be fishing, but you want to do it alongside expert fishermen and kind of look over their shoulder and do what they do. Or maybe it's D, something else. So what do you think? A, B, C, or D? Just let me know really quick. I see people are typing in learner, some A's and B's. Some people are saying they're B's and C's. Good. A little bit of everything. I'll try to make you all happy. Okay. I always start with this. You guys have seen this a million times. I'm just going to ask you to humor me. If I gave you 50 grand right now, would you take it? Or if I offered you a penny that doubles every day for a month, which would you take? So notice the $50,000 is all about you don't have to do any work for it, right? But a penny that doubles every day for a month, there's a time commitment, and actually there's going to have to be some activities, right? You're going to have to do something every day. So, okay, if you take the penny and you're doing it every day, by the end of the first week, you've done the activity every day that requires you to double that penny. But at the end of the week, you might be regretting not just taking the 50 grand, right? Because all you have to your name is 64 cents. And you're wondering, should I continue with this, or should I get distracted by the next shiny object that comes along? All right. Day 10, $5.12. So you're still like a power of 10,000 off of the $50,000, right? Let's go to the second week, right? Second week is about halfway, a little under halfway through the month. You got $81.92 to your name. All right, we're up to third week, maybe about 3/4. I mean, gosh, you're 3/4 of the way through the month. Things are looking nicer, but you're still nowhere near the $50,000. You still only have about $10,500 in your account. But sure enough, around day 24, you're already, gosh, you're very much through the month. You had to really stick with it. And it's on the back nine, as we say, if you're golfing, that you finally surpassed the 50. And then that last week, well, by the end of the month, you could be walking away with about $21,474,836.48. This is what we call compound interest. And I'm not sure if Albert Einstein actually said this, but it is attributed to him, most powerful force in the universe. So with that in your mind, I want you to look at this graph a little bit. This, just like that chart of a sideways channel, I'm going to come back and bring more context to it, but just notice a couple things here. First of all, this is a exponential drawing, meaning it's parabolic. Instead of just being linear, it's going to be parabolic. You'll also notice that there's two lines, right? There's this line that says range high and this one that says range low. And range low, this is a zero line, because this is -20 and this is 30, so this must be 0. Range low becomes above 0 between this 1 and this 2. I'm going to give this more context later, but kind of, if you don't mind, tattoo this look into your brain here, because we're going to come back and give that context. So I'm going to reverse engineer that doubling equation to, if we doubled our money every year, right? If we doubled our money every year, that means going with just simple interest, not compound interest, if you earn 6% on your money every month, then we would be able to get our investment to more than double every year. And that's important, right? Because if I start with $1,000 investment today, and I'm talking about investing strategies today. So for those of you who think you can do this and get rich quick on zero money down, this is not for you. This requires you to have money for a portfolio. If you have $1,000, then by the end of 12 months, if you focus on just that 6% gain per month on your portfolio, you'd have $2,012. In 2 years, you have $4,048. In 5 years, you'd have close to $33,000. And of course, in 10 years, you'd be a bona fide millionaire, but you'd have to stick with it, right? You'd have to focus. And in the beginning, just like we saw with the penny, it may not make sense because you're like, man, I could do something else. I can get easily distracted by other stuff. But if you stick with it, man, with just $1,000. Now, some of us are starting with more than $1,000. That's going to speed you up. The other thing that I like is if you grow your portfolio to about $100,000, which is what I did early on, that means that you can actually start taking money from your portfolio. That $100,000 portfolio is going to generate over $100,000 every year. That's more than the median income, salaried income of a white-collar worker here in the States. Now, I know if you're on any of the coasts, that doesn't make sense, but across the United States, the median salaried income is $87,000. So this is more than that, and this is having your money work for you rather than the average salaried work week is about between 50 and 60 hours. So I like this, and I subscribed to this in 2005. When I quit my day job at Hewlett-Packard, and I never went back, and I've been living on my trading returns ever since. So what are we actually investing in? Well, I'm selling theta decay optimized option premium. Some of you who aren't familiar with the ins and outs of options are like, what the heck did he just say? I'm profiting on the component of options that makes money when time goes by. It's a very reliable variable time, right? It doesn't require the underlying symbol to have a direction. It doesn't require implied volatilities to change, go up or down. I'm profiting on every second that goes by. So before I go any further, let me just make sure we've got some reading comprehension here, some listening comprehension. What are we focusing on for monthly returns on our portfolio to double our money annually? Is it 0.5%? 1.5%, 5%, 6%, or 10%. Just jot that down just to make sure you guys are paying attention, that I haven't put you to sleep. Good. So if you wrote down D, 6%, you're spot on. That's exactly what I said. Now, some people are saying, you're talking options, dude. Isn't that risky? Well, options were actually created to remove risk and turn certainty into big money investors. So it's how they're used. First of all, if you're just trading stocks, indexes, or ETFs, if you go long, you can make money if the stock goes up. If you go short, you can make money if the stock goes down. There's only two ways, going long and going short, with your underlying symbol trades to be able to make money. But options, I can make money with different strategies and different selected options in those strategies when the underlying symbol goes sideways, as well as up and down. In fact, I can make money as time goes by, which I talk a lot about. In fact, even when there is fear or confidence in the market, so long as I know what side of the transaction I'm on, I can make money when any of those situations happen. Options are incredibly flexible. And so used correctly, they actually remove risk. But used incorrectly, well, don't forget, there could be, options do have this thing where they could be used as leverage, right? And if you use the leverage incorrectly and don't calculate the risk involved, yeah, they could be trouble. So you have to use them correctly. But some people are even saying, I've heard of options. I don't even know what you're talking about. Like, what is it? Well, it's a financial instrument called a derivative. It's like a future, an option. These fall into that same category. They're typically bought and sold by big money investors to hedge risks against stocks, indexes, and exchange traded funds. But what I like to do is I like to sell their premium, their extrinsic value, to generate income. Okay, so let's go over some of those details. I can pass through these next couple of slides if, depending on the next answer to the question. Have you guys already been introduced to me? Do you guys already know my backstory? If so, I don't have to tell you about myself. The question is, just type it in the chat. Have you heard of me before? Yes or no? Yeah, I got some yeses, most no's. Listen, I'll go through this really quick. A lot of different ways you can check me out. I've got a YouTube show every Friday morning at 11 a.m. Eastern time, which is pretty early, 8 a.m. for you guys on the Pacific Coast. You should check it out. It's free. It's awesome. We go over current events. We go over option trading strategies. It's kind of fun. I'm on all these other social medias. You can definitely go to my website, TT for me, and read all the articles and white papers. You can contact us. You can call me on the telephone. If you're at any of those social medias, do me a favor and hit that subscribe button. That always does very well for the algorithms to get us to be in front of more eyes. I'm just out there trying to help people with their investing. I founded this company called Trading Trainer. People like the peers, they always seem to call me the world's most disciplined options trader. I actually think behind my back, they call me the world's most lazy option trader. I like to think of myself as the world's most efficient option trader. That's because I like to minimize the amount of effort, amount of emotional roller coaster, amount of initial investment that I have to put into my trades in order to get them to work. I like to really have the most efficient trades, just have them just give me like an ATM, just pay me incomes every month and not put too much like white knuckling. I hate white knuckling through trades. I've been doing all this equities and options trading since 1997. I've been doing this newsletter for my Trading Trainer participants 5 days a week since 2002. There's a ebook you'll find on most successful option traders' computers called The 7 Strategies of Successful Option Traders. I wrote that in 2004. Home study course you'll see on people's shelves. But the key thing I want to instill in you is I'm really just a big learner. I mean, I buy everybody's programs, even to this date. I want to see, first of all, who's for real and who's for not real, because a lot of the programs out there, especially the ones that come and go, they're not worth the paper they're written on. I got a degree in mechanical engineering. It's the marrying of electrical and mechanical engineering. That's automatic controls. So I've got from UVA, I have electrical and mechanical, and then from University of that's University of Arizona, I have a master's degree in mechanical engineering. I've also got a strong background in commercial business and investing, and for the last 15 years, I've really been focusing on the psychology of teaching, because my big thing is teaching other people how to do what I have done. And that first year, 1997, this was before, AOL dial-up, people were still teaching about trading back then. And that first year, you would go to and some of you may identify this, you would go to the hotel conference rooms on Saturday. You'd either go in Saturday morning or Saturday afternoon. You'd spend about 3 or 4 hours there. They'd teach you something, but then they'd get you to come back on Sunday if you pay an extra fee, and you'd stay all day Sunday. And then at the end of Sunday, they'd get you to buy something where you'd fly somewhere and spend like 3 or 4 days. You guys remember that? Those type of seminars. Now you do everything on the web, but back then, that's how you did it. So every weekend I would go to a seminar. I was in Silicon Valley working at Hewlett Packard. So I had the money. I was single. I didn't have a mortgage payment. I didn't have, I didn't have the kids or anything like that. So I had a lot of money because HP was paying me very well. I spent $27,000 on seminars that first year. I still spend even more than that now every year on other people's programs. But the other thing that was key was I gave $85,000 back in 1997, making stupid investments, trying to follow what those people had been teaching. That cost more than my undergrad and my grad degree combined. And so interestingly enough, I always call this my second college thing. Let me give you 4 shortcuts, because this is what I learned between 1997 and 2001 when things started to sink for me. And I'd like to shortcut it because I know some of you aren't seeing successes right now. And I don't want you to spend 4 years learning, losing a crap ton of money when you could be shortcutting this process. So here's my top 4 things. Please write this down. So number 1, don't stop chasing shiny objects. I opened my presentation with that. Stop chasing shiny objects. Settle on one type of investing and learn it well. There's no better type of investing, no matter what the marketing tries to get you to be interested in. Look at, like I said, your personal schedule, your personal availability, and that should, are you going to be an end of day trader? Are you going to be just an active investor who gets into mutual funds? Know that information, right? And then pick somebody to learn from. And what you want to do is you want to hire a mentor who is currently doing what you want to do and knows how to teach. Because there's a lot of people who are successful, but man, they cannot impart their knowledge, right? Learn from guided discovery. It's so much easier and takes so much less time than learning from trial and error. Join an investment group, right? Join a trading group. Not only because they will hold you accountable and make sure you stick with it, and also while everybody in your personal life will be telling you you're crazy for getting into stocks, options, or whatever your investment vehicle is, they'll make sure that they tell you that you're sane, which is always good. It keeps you from, self-sabotaging yourself. But the other thing is you can look over their shoulder, right? Some of those investment people will be doing trades that you would have never even thought of. And now you have the ability to do that. This is actually, these steps are exactly what I did, which changed me from being a loser to being somebody who started to make money in 2002. Finally, I want you to surround yourself with like-minded investors. And again, this goes back to not having naysayers planting seeds in your head that you're crazy for wanting to make money this way, because this is actively investing is a great way to parlay your savings, right? So this is exactly what I did. All right. Last but not least about me, and then we'll get back to premium selling, is my foundation. I always like to plug this. I started a foundation in 2003 where I took 9 historically underserved inner city kids off the streets of Denver, actually a suburb called Aurora, which is not a nice place. And I taught them how to invest. We were stuck. Now, by this time in 2003, DSL was around. We were a lot less people doing dial-up. We had DSL, and the libraries had it. And that's where these kids obviously didn't have DSL or computers at their own home. So we did it at the library, and the library limited us to only a half an hour on the computer every day. And so I had them for 6 months. And I'll tell you, at the end of the 6 months, I gave each of them $2,000 of my own money, thinking I'd never see it again. And I'll have you know that each of these kids, not only did they pay me back, but they all went on to buy computers and internet connections so they could do this at home. And now, fast forward, we're talking 20 years later, we've got a professor at Denver University. All these folks are very successful now. We've actually been running this program every year. It's been growing. We actually moved it from Denver to Southside Chicago. We've partnered with the Chicago Board of Options Exchange. They do that with me. And we bring in a class. The last time we did this before COVID, we haven't restarted it after COVID. We're still making sure people are safe. But last time we did this, we had over 120 graduates. So it's kind of what I care about. And this is, all the profits from my trading trainer company go to this foundation. So just wanted you guys to know why I do this in the first place. Back to the topic of how we sell premium. So we focus on 4 simple transactions: writing covered calls, writing covered puts, flipping the covered call upside down, writing covered calls against leaps. This is supercharging our covered call writing out there. For you guys that are kind of experienced academic types, this is a variation of a bull call diagonal debit spread. And finally, writing covered puts against leaps, supercharged covered put writing. Today, we're going to cover specifically this guy, writing covered calls and writing covered calls against leaps, as well as how to marry protective options to it. If you guys don't get yourself into, I wish I had more time because I'd cover covered put. This is very powerful. These 2 strategies, I put the arrows by. Put a check mark next to them, by the way, because these 2 strategies are in heavy demand right now. We're using them a lot in my program. So make sure, if anything, you go on and do a little self-study on that. The other thing is these 3 of them, the covered calls, the bull call diagonal debit spreads, and the bear put diagonal debit spreads, these are cash trades that a lot of my program participants are doing in their retirement accounts, their Roths and their traditional IRAs and SEP plans. So that's really nice that you can do this stuff with your retirement money. This one right here, the covered puts, because of the initial covering position, it's a shorting of the underlying symbol. It does require a margin account. So I like to put that out there. But what's nice is this guy is a variation of this guy. And this guy, the bear put diagonal debit spread, is a cash trade. So if you're looking to get the same accomplishment with all the benefits of the bear put diagonal debit spread, it does basically the same thing, and it can be done in a cash account. So just a couple of notes. We're going to get into some details on covered calls. But first of all, I keep talking about selling option premium. Realize that when you look up an option price on the big board, the option price, it's equal to 2 components: the in-the-money value and the premium value. In the money is also known as intrinsic value. Again, I know there's some nerds like me out there that have some academics in them. And the premium value, we call that extrinsic value. Some people call it time value. I hate that name because it has so much more into it than just time. There's more in that premium than just time. But you'll also hear people call it time value, although to me that's like somebody scratching their fingernails on a blackboard. So when you look up an option price, always realize it's these 2 components in there. And I'm specifically optimizing how to make money off of selling the premium value. So let me give you an example, because at the end of the market today, so about an hour and a half ago, Ford closed at $13.91. So what if we bought some Ford stock at $13.91 a share, and then immediately sold back the Ford December $14 call? It expires on the 3rd Friday of December. Options, the monthly option expiration is always on the 3rd Friday. I would make 65 cents per share back. That would act as a discount on the underlying symbol. It would act as a expiring coupon, because as this goes on, its value will decrease, and so I won't have to pay it back. I could probably get to the point where I pay back nothing. It expires worthless. Also, it's almost like getting a dividend, an instant dividend, and it would be a dividend of $65 per option contract sold. Write this down. There's 100 option shares in an option contract. We sell option contracts. You can't sell them per share. So for every option contract we sell, we'd make $65 in an instant dividend. Okay, so let's run through the scenarios of what happens on the 3rd Friday of December, December 16th. If Ford closes above $14, it will want to be exercised, right? So I paid $13.91. I'll get the $14 for getting exercised, which is not very much profit. But don't forget, I collected 65 cents up front. So when all is said and done, I walk away with about 5.6% ROI. Now, that's a little bit less than the 6% I was talking about. So we'll have to figure out how to boost this up. But this is a good start. Let's see what happens if Ford is flat by December 16. Don't worry, Don, I'll be getting to your scenario because we're going to figure out how to marry a protective option so that we can not worry about getting screwed, as you put in the chat. So what if I pay $13.91 and we are flat sideways? I get to keep that 65 cents. The option expires worthless. I've made 4.9% ROI so far, and I'm going to do it again and again and again. In fact, this is the ideal case. I would like to be able to sell these options against this one stock for as long as I can just to create an income. In fact, on average, the folks in my program are doing this and it lasts about 5 months. That's the center of the bell curve. That means it goes from anywhere from 3 to 8 months that we just collect income every month before getting exercised or bailed out. But now what if Ford drops by December 16th? So we paid $13.91 for Ford. We got the 65 cents. That actually reduced our break-even price to $13.26. We call that a profit buffer of 65 cents. That means that Ford would actually have to drop below that break-even price. Built into this strategy is a 65-cent buffer before this goes into the red. Now, stay tuned. I am going to be talking a little bit, like in about 5 minutes, on how to marry a protective option to this so that the risk on reward is even lower. We can stop the risk. But I want you to just understand that built into this strategy, we have this profit buffer of 65 cents. So looks pretty good so far. I want to show you an actual trade that actually got exercised. This is one we did on American Airlines. It's not one of those ones that lasted 5 or 6 months or more. This is one we did on September 6th. We bought American Airlines. I bought 800 shares, paid about $13.06 a share after commissions, $13.07, about $10,453. I immediately, not immediately, 3 days later, and I'll show you about timing the trades. 3 days later, I sold the call. I got 49 cents. I sold 8 contracts to match the number of shares, 49 cents per share. Sure enough, on the 3rd Friday of September, I got exercised out. It expired. I got that $14 for the strike price. Wound up walking away with 10.8% ROI for a trade that took 2 little moves. These are end of day moves, so it doesn't require me to be day trading during the day. That might bum out. Somebody wrote to me earlier that this was also Don. Don's a day trader. And he likes to have an alert service that tells him stocks that he can do options on. So he's a directional trader. This is a little different than what he's doing. I'm selling premium. And so I did this thing. I was pretty lazy on September 6th, bought some stocks, September 9th, sold the option. And then on September 16th, it all closed by itself. I didn't have to do any of these transactions. So 2 little transactions, 3 days apart, and I made almost 11% on my money. So before I go any further, let's make sure we have some comprehension here. What does investing by selling premium create? Does it create an instant dividend, a discount on a security, a profit buffer, an expiring coupon? There's more than one answer. So what do you think? A, B, C, D, combination A and B, B and C. What do you think? If you answered all of them, you're absolutely right. If you didn't, don't worry about it. Just make sure you jot them down in your notes. Okay, now I'm going to start asking you questions in advance of me presenting the concept. How can we lower our investment increase our returns, and even convert a margin trade into a cash trade. So you may have to guess on this. No worries. Again, nobody's going to, it's only between you and me if you get it right or wrong. Should we sell out in time options? Should we replace the security with options trading at parity? Should we give up and buy mutual funds, or is what I'm talking about not even possible? What do you think? A lot of answers are coming in. Let me tell you about this guy, because a lot of people are saying A or A and B. Here's the scoop. Selling out in time options, the payback for going farther out in time, the risk you take on for the amount of payback isn't worth it. So stick with, for those of you that have some experience, stick with near-term options that'll expire 3 to 5 weeks, because after 5 weeks, the options payback is not worth its risk that you're taking on. Because when you sell an option, you are taking on, you're becoming obligated to be exercised. So you want to make sure you understand that. So the answer is actually B. We're going to replace the underlying security, whether it's a stock, index, or ETF, with something trading at parity. So you might say, what are options trading at parity, AJ? Well, option premium is the most when the option is at the money, right? That's a given. Maybe it's not a given, but I'm telling you that's a given. But when we go deep in the money, the option actually loses its premium and it becomes almost completely intrinsic in the money value. And you're like, what the heck does that mean? Well, let me summarize it. A deep in the money option behaves exactly like its underlying security, dollar for dollar, only at a cheaper price. In other words, we're now involving a tiny amount of leverage. And you might say, okay, but if I do this substitute, how far out in time should I make sure that option expires? Well, I told you that our strategies, when you look at the bell curve from my participants, I've got over 400 people participating in this program. When you look at it, most of their positions are lasting on average 5 months. Now you see the bell curve taper off at about 8 months and start up at about 2 or 3 months, but the most of them are lasting about 5 months. But if your position could go 8 months, then we want to make sure we can take advantage of that. So you want to substitute with an option that's at least 8 months out. At least 8 months out. So that would right now bring us to what? July. Because tomorrow is the third Friday of November. So if you were substituting an option, you probably want to use at least a July. Now, we typically use leaps. And the reason why we use leaps is because leaps have more liquidity, but it's not a requirement. If you've got liquidity, like for instance, forward options have a ton of liquidity. So if we go past July and forward, we're good. So we typically use leaps because of the liquidity, but it's not a requirement. And some people are asking, as far as the options you were selling, you said sell 3 to 5 weeks out. What if I only want to sell 1 week out, like weekly options? That's fine too. A lot of my program participants do the weekly options as well. It's a little bit more involved, meaning you're going to be more active. And this is Don asking the question. He already told me he's a day trader, so he doesn't mind that it's more active. So you can definitely do weeklies. The other problem that I personally have with it is that my portfolio now is over 8 figures, and the liquidity on the weekly options isn't enough to support my personal trading. So that's why you'll hear me talking a lot about monthly. But a lot of people in my community do weeklies, so it's definitely there. All right. Let's get back to finding a substitute that trades at parity. First of all, $13.91 for Ford, or we can go out to the September 2023 $8 call. That thing's only costs $6.20. It's less than half the price of Ford stock, and it's going to act exactly like Ford stock. The premium component there is less than 5%. It's only 4.7%. So it's pretty much going to move dollar for dollar with Ford stock. So let's run through the scenario. If instead of buying Ford stock, I buy contracts of the Ford September 2023 $8 call, only pay $6.20. And then I stick with the same at the money option, the Ford December 16th $14 call. That thing gives me a instant dividend, a discount on the underlying symbol. In this case, it's the back month call option of 65 cents per option contract sold. So let's run through the scenarios here. What happens if Ford is above $14 on December 16th? Well, we paid $6.20 for that back month call. We're only going to get the difference. If we get exercised, we're going to get the difference between the two strike prices, 14 and 8. So I'm only going to get $6 for getting exercised, which you might say, oh, crap, that's a 20-cent loss. But wait, I made 65 cents on selling that front month option. That turns out to an 8.1% ROI because I reduced my cost basis, right? Remember, I was focusing on getting 6%. Now I'm at 8.1% ROI. Nice, right? But what if Ford is flat by December 16th? Now, this is my ideal case. I actually look for symbols that are going sideways on purpose. I get that 65 cents to apply to the $6.20 initial purchase. And guess what? That option expires worthless. I keep the 65 cents. I made 11.7% ROI so far, and I'm going to do it again and again and again. And then, of course, what if Ford drops? Same thing. I've now got a 65-cent profit buffer. So Ford would have to go below the back month call option, the $8 call expiring in September 15th, 2023, would have to go all the way down below $5.55 per share in order for this to go into the red. Now, don't worry. We're now about to talk about how to marry a protective option. But not before I show you my actual real world example. I got to show you my real world example. So Starbucks, this is similar. And now this guy, again, this isn't an example. This is an example that got exercised right away. But on September 6th, same thing was going on with American Airlines. September 6th, I bought 3 contracts of the Starbucks January 2024 $50 call. So notice I went all the way out to the leap in 2024 because of liquidity. Starbucks didn't have as much liquidity on the options that were expiring in 2023 back in September. So I went all the way out to the leap in 2024. This was a $50 call. I bought these things for $36.40. Basically, I invested just under $11,000. Now, 3 days later, I went ahead and sold the premium. I made $1.60 per share, basically made an instant dividend of $477.90. And then sure enough, I got exercised. Now, what's the difference between the strike prices? 50 and 90. So I made $40 when I got exercised. And so in this case, I walked away with, I don't know why that says General Electric. Let's just calculate it. I'll pull up my calculator. I walked away after, and this includes all my commissions. I walked away with $5.18 on an initial investment of $36.40. So 14.25%, 23%. Let's write that down. 14.23%. Not bad, right? Cool. Remind you that 6% is our target. That'll double. Guess what? Our folks in our program are actually making way more than 6%. They're making double digits. And if you look at their portfolios on average, they're doubling their money every 7 months. And that's during this crazy downturn that people are talking about. They're doubling their money in their portfolio every 7 months. But we focus on the moon and then maybe hit the stars, right? So we focus on that 6% number. That's what we kind of singly focus on to beat. All right. How can we drastically reduce our risk on return? What should we do here? What do you think? Should we sell half as much option premium? Should we sell out in time options? Should we collar the investment by marrying a protective option? Or is what we're talking about not even possible? What do you think? A, B, C, or D? You heard me kind of like hinting at it. We're going to collar the investment by marrying a protective option. So let me show you one last trade. This is more like the trades that we do, but I just want you to focus. This one went on for months, but this is a perfect example of a couple of things. First of all, I bought the stock on August 26th of 2020 for $34.73, right? On September 1st, I did 2 transactions. I sold the premium, and then I went and I bought a protective option. The protective option is about 3 to 6 months out, right? In this case, it was like, what, 4 or 5 months out? I aim for 3 to 6 months out. And then look what happened. Fast forward to the 3rd Friday of September. The option I sold, $1.76, expired worthless. So that means I got to keep the whole $1.76. And then a couple days after that, on September 24th, I sold back the protective option because I didn't need it anymore. As soon as that option expired worthless, I didn't need the protection anymore. I sold it back, and I sold it back at a profit. So check this out. Some of you are like, the light bulb's going on. Some of you, it hasn't gone on yet. Not only are we making money by selling the premium, but I'm making money by rolling out the protective option. So the protective option has 2 purposes. Not only is it protecting me should the underlying symbol go against me, it's protecting me from a strike price of $34 down, but it also is a secondary source of income. When you talk to other traders, a lot of times when they hedge their investment, that hedge is actually a loss. It's a cost to the overall economics of their position. The way we do it here with our timing is we always make it so that it actually becomes a profit center, not a cost center to the economics of the trade. So not only did we make $1.76 on the premium, we made $1.15, if I'm doing the math in my head correct, on rolling out the option. The next month we did it again, sold $1.47 for the option, bought the protection for $3 and a penny. The premium expired worthless, and when we sold back the protection, we were able to make an additional 61 cents on it. It's kind of like the frosting on the cake, and we just rinse and repeat, rinse and repeat, rinse and repeat. But here's the other thing I want you to notice. The other thing I want you to notice is right here. Look at our cost basis. So after the first month, we wound up with a cost basis of $31.86. We're protecting this position with a $34 put. In other words, we reduced our cost basis to below where we're protecting. In other words, we're over-insuring this position. What does that mean? Take a look at this curve. This is that curve I showed you earlier. This is this actual trade right here. First of all, there's our break even. This is the average time our premium selling investments last. And so if you go with that, if our position gets exercised 5 months from now, we walk away with 65% ROI. And if the position goes against us, we still walk away with 50% ROI. Everybody talks to me and they're like, what happens if the underlying symbol goes against you? Well, the cool thing is whether the symbol goes for us or against us, we walk away. I'd be totally happy with either of these returns when this position gets cashed out, right? It doesn't matter what the underlying symbol does because I'm profiting on time passing by. I hope that hits home for some of you. The other thing that's interesting is when this trade becomes risk-free, when it becomes break-even. And I got to look at the watch here because I want to make sure David told me to be done, and I want to make sure I tell you about my program. But before month 2, this position becomes risk-free. And this is not a special position. This is typically what happens. After selling premium the first time, we now have a risk-free investment. In fact, I'm going to pass this, but the answer to this question, what do we have when our cost basis or our break-even price is less than our protective bailout price? It's a risk-free investment. And so most of our positions are risk-free. All we have to do is hold them for a month or longer and they become risk-free. So here are the 3 steps. We're going to buy or short an underlying security, or we're going to buy a substitute option trading at parity. That's step 1. Step 2, you're going to sell a near-term at-the-money option for its premium value. You're going to create that instant dividend and that profit buffer, and you're going to collar with a married option that is 3 to 6 months out in expiration to protect your investment. And there's a timing to it. You find these sideways channeling symbols, which if you look at stock symbols, especially right now, sideways channeling is where they're at. If you're doing the covered call or the diagonal debit spread, the bull call diagonal debit spread, you start at the bottom, and then once it tops, you sell the near-term call, buy your protective option. That call expires worthless. You roll out the protective option and you rinse and repeat. Rinse and repeat, rinse and repeat. If you're doing it the other way, we didn't cover this strategy, but this is if you're going to do the covered put or the bear put diagonal debit spread, you start at the top. At the bottom is where you sell the near-term put option and buy the 3 to 6 month out protective call option. That near-term put option expires worthless on the 3rd Friday, or if you're doing weekly options like Dawn, then it expires at the end of the week. And then you sell back the protective call option and you repeat, repeat, repeat. Just create income out of this. And as you notice, this is not, a day trading thing. This is doing a transaction about twice a month. Twice a month, we have to be able to do a transaction in the markets, and otherwise you just let the time do its thing. So I'm in a little bit of a rush. I've got about 4 minutes. How would you like to never miss a pick, minimize the amount of time you spend away from your loved ones, and have the support whenever you need it? That's what it's all about. It's all about saving time, creating clarity, getting results. So I'm going to take a couple of moments to tell you about my materials, training, and tools to see if they're right for you. And I'll answer the question about IV if I can right at the end. This is for people who don't want to pay for multiple data subscription, wants everything they need in one place, doesn't want to miss any opportunities, more time doing other things than sitting in front of their computer. They don't want to be alone. They want step-by-step instructions. In other words, in summary, you want consistent, reliable results. I'm going to pass the testimonial. Listen, it involves a lot of good things, but there's video tutorials, as you can see here. I'm showing you my member website, video tutorials. We have a once-a-month lecture. But here's what I really want you to know about. Every week, and we're actually going to do one tonight at 9:00 p.m. Eastern Time, 6:00 p.m. Pacific Time, we get on the phone with everybody. Usually there's about 100. There's about 25% of the active participants who show up live. And we go through the symbol of the week. And we plan it out in a workshop very similar like this. And we give everybody the plan. So we call it Learn While You Earn. You get the trading plan at the end of the workshop, and you get to see how we plan it out so you can go do your own on your side. But some people like to do this as they kind of watch as we do it and then do the same thing. You get a pick every week. And then the premium selling screeners, we've got screeners, all sorts of where you can find picks to do this on. But the other one is right here, trading questions. We ask everybody to please send us their trade plans and what they're going to do for us to review them. I personally review them, and we send back feedback. And this way, you again, learn while you earn. We can make sure that you're not going to do any stupid trades. I can stop you in advance, right? All right. So what is all that to you? So the video tutorials, monthly live classes, screeners, planning tools, weekly. We didn't even talk about the planning tools, weekly live workshops and their replays, the trade review, and then also there's a double your money back guarantee. So I am going to ask that you work with me for 6 months, right? I want you to come to my workshops or watch the replays for basically 26 weeks. If at the end of the 6 months, you're not making money doing this, not only am I going to refund what you pay for this program, I'm going to give you twice what you paid. That's how confident I am that this works. And I'm going to give you a free strategy session with one of my coaches to help you get from point A to point B. So adding in the double your money back guarantee, strategy sessions, 6 months, what is it worth to you? Think about that. And just for Don, as I said, we're doubling our money in our portfolios about every 5, 6, 7 months right now. So this program, if you go on our website, is $597, but for the Synergy traders, and that's flat fee. I'm not going to ask you for any more money than that. It's a flat fee for 6 months. I'm going to take $100 off just for you guys. Here's what you have to do. You have to go to optioninvesting.org/synergy, and you have to put in this promo code. So I'm just testing it out. This is optioninvesting.org/synergy. And I'm going to put in 100 DISC, all capital letters. 497. There it is. So my programmers did it. The website is working. Do not pass go. Do not collect $200. In fact, if you want to call us, you can call us and we can place the order over the phone. And that brings me right up to the end of my time. I actually went a minute over. IV is good. Just remember, for the person who asked about implied volatility, options expire worthless. The premium of an option expires worthless no matter what the IV is doing. So if we're holding the options close to the expiration date, then they will go to zero. Thank you, David. Thank you, Anka, if you're out there.